Welcome back to Accounting 102. In this video, we're going to cover Chapter 9, Budgetary Planning. So if we look at the learning objectives for Chapter 9, we're going to state the essentials of effective budgeting, components of the master budget, prepare budgets for sales, production, and direct materials, prepare budgets for direct labor, manufacturing overhead, selling and administrative expenses, and then pull that all together for a budgeted income statement. Then we'll look at preparing a cash budget and a budgeted balance sheet, and then we'll apply these principles to non-manufacturing companies. The budget is a formal written statement of management's plans for a specified future time period expressed in financial terms. Okay, so basically it's a financial kind of roadmap of what we think is going to happen in the given time period, typically a year. It's what are our sales, what are our costs, what are we going to purchase, that type of thing. It's the primary method of communicating agreed upon objectives throughout the organization, promotes efficiency, and can be used as a control device. So it's an important basis for performance evaluation once adopted. So a lot of times companies will set their budget and then bonuses and other performance metrics are going to be based on that budget to help with pay and evaluating performance for individuals. We're going to use historical accounting data on revenues, costs, and expenses to help in formulating future budgets. The accountants are normally responsible for presenting management's budget goals in financial terms. A lot of times with budgets, there's also non-financial goals and objectives that they want to do as far as efficiencies and maybe going into some new markets, that type of thing. So it does eventually have a financial impact to it, but the accountants and the finance people take care of the financials, and then the management team, the rest of the management team takes care of the non-financial aspects of it. The budget and its administration are responsibilities of management. Some of the benefits requires all levels of management to plan ahead. If you do a very effective budget, everybody's going to get involved and agree to it. So gets everybody thinking about what's going to happen in the future. Provides definite objectives for evaluating performance. So when we agree to the budget, that's set. The budget doesn't change. We may reforecast as we learn things throughout the time period, but the budget usually doesn't change. It creates an early warning system for potential problems. So if we start veering off of our budget sales or costs, we can see that earlier and kind of react to it as it's happening or before it happens, and make corrective actions quicker. Facilitates coordination of activities within the business. So as you see, we'll go through how we build it. The different departments have to work together to build their part of the budget and how it comes together in one big budget. Results in greater management awareness of the entity's overall operations. So again, it's a time, typically annually, as what companies do. They look at the whole operation. So it's kind of a way to step back and look at everything together. And it motivates personnel throughout the organization to meet planned objectives. So if you buy into the budget and help develop it, you're going to be more motivated to control your costs and hit your budget, especially if there's incentives and that type of thing based on it. So which of the following is not a benefit of budgeting? So the first one, management can plan ahead. B is an early warning system is provided for potential problems. enables disciplinary action to be taken at every level of responsibility. The coordination of activities is facilitated. And the answer is C. It enables disciplinary action to be taken at every level of responsibility. That is not a benefit of budgeting. We talked about being able to measure and provide a format or a level of, doing some of that discipline or bonuses and incentives based on the budget, but it doesn't, the budgeting itself doesn't enable disciplinary action to be taken at every level of responsibility. For effective budgeting, you have to have a sound organizational structure. It's got to have authority and responsibility for all phases of operations clearly defined. It's important for running the business. It's very important too for budgeting because you got to understand who's going to do what and who's responsible for what parts of it. It's based on research and analysis with realistic goals and accepted by all levels of management. So if you get everybody involved, then everybody's going to be accepting of the budget. The budget may be prepared for any time period. Most common, it's 1 year. So it's an annual process. Typically starts in most companies, especially the ones that I've been involved in, you start in June or July thinking about next year. So you're halfway through the year, current year, assuming you're on a calendar basis. And even if you're not on a calendar financial structure, you're going to do it halfway through the year. You're going to start thinking about next year, looking at what contracts and stuff that you may be coming in that are new, some that may be dropping off. But then you do it for a year, but you're also going to have monthly, quarterly budgets as well. And you could have different budgets that cover different time periods. A newer thing that people have been doing is kind of a rolling budget, where you do a 4-quarter budget and you're always updating it. So at the end of each quarter, you're redoing the budget for the next 4 quarters. You can do the same thing with forecast, but it gives you, it breaks the cycle of just doing it for, the calendar year and stopping and then redoing that. It kind of keeps it rolling. The budget is long enough to provide an attainable goal and minimize seasonal or cyclical fluctuations. So companies sometimes have higher sales in the second or third quarter versus the first or fourth, or some different cycle. So doing a year, you're gonna get through that whole cycle, and it kind of minimizes that. But then it's also short enough for reliable estimates. If you look at too long of a time frame, you're kind of guessing at what might happen with inflation and salary changes and sales projections, that type of thing. It's important to have some long-term thinking as well, and we'll get into that in a few slides here, but the budget has to be short enough that it's we're going to base the budget goals that we're creating on past performance, collecting data from organizational units. I mentioned earlier, we begin several months before year end. My experience has been, June, July, August is when you're starting and getting into the budgeting season and getting heavy into it. Typically, you may have a couple reviews, but you'll do kind of your first presentation maybe into September, early October, and you get a chance to do some refining, and then finalizing in November, December timeframe. So by year end, you've got a pretty good budget for the next fiscal year. And then sometimes they even come back after you close the fiscal year and make any revisions that you need to do Very important, especially for cash flow and balance sheet, because you're estimating those ending balances, and we'll see that as we develop that, see how that's developed, and then so getting that starting point correct will help you as well. Develop budget within a framework of sales forecast. So really, sales is what drives the budget. Knowing what you're going to sell, it's going to drive what what you need to manufacture, what you need to buy, and that type of thing. So it shows potential industry sales, shows companies' expected share of those sales. So if you're in a competitive market, you're going to look at the whole industry, try to figure out what is happening there, and then what portion of the industry that you have, and what you've typically had. So sales forecast, we're going to look at our general economic conditions. We'll look at industry trends, market research studies. Depending on the industry, you're going to have some research groups that publish, kind of what they think the industry will doing. So my last company I worked at, we were automotive supplier. So there's a lot of, there's a couple different big groups that look at the auto industry. They're projecting sales of cars. So even, and then the big automotive makers are putting forecasts out as well. So we can look at, okay, we think Ford is going to sell the Ford Explorer, how many units in what time period, what they're going to do with the F-150, that type of thing. And then knowing what parts go onto that vehicle is how we could build our budget out. You'll look at any advertising and promotion you may be running, the previous market share, changes in prices, technological developments. So all the things that are going to impact sales, some positive, some negative, and kind of look at all that together to put together our sales budget. Participative budgeting. That's where each level of management should be invited to participate. So the closer you are to actually what's happening in the business, probably the more information you have and can better impact and define the budget. It's a bottom to top approach or bottoms up approach, as opposed to a top down. So the bottoms up is kind of you're building the budget from the bottom and then rolling it up. May inspire higher levels of performance or discourage additional effort. So if you help develop the budget and then you're going to get measured on that budget, you're going to try and beat it. So you may increase your performance because you're bought into what that budget is. Depends on how budget developed and administered. Advantages of doing a participative budgeting. Excuse me. It's more accurate budget estimates because lower level managers have more detailed knowledge. Perceived process as fair due to involvement of lower level management. Sometimes when you do a top down or you just give a group, here's what your budget is, they don't buy into it or they don't agree with it because they didn't have anything to do with it. So they sometimes just kind of ignore it because I don't know where it came from type of thing. The overall goal is to produce a fair and achievable budget while still meeting corporate goals. So what we've talked about and what we'll continue to talk about is a plant or a smaller company building it from the bottoms up. But if you're part of a bigger corporation, they're going to have goals for each division or each plant. And so you've got to kind of meld those together to try and figure out, how do you agree? So you may build a budget you think is attainable and achievable, a little bit of stretch in it for your plant. The company may come back and say, no, you need to make it, 3% higher or something like that. So then you're scrambling to kind of try to figure out how you can fit that into what you thought was a realistic budget as well. There's negotiations that go on with that as well. Some disadvantages: it can be time consuming and costly. That's why it's starting so early in the year. You've got to take time for people to analyze their data and their numbers and pull it together and then do roll-ups and then do different levels of review and challenges. And then there's some budgetary gaming through budgetary slack. Also refer to it as sandbagging. So if I know, my budget isn't going to be accepted and it's going to be cut, I'm going to add some extra costs in there. So when it gets cut, it's more in line with what I thought it was. The trouble with doing the bottoms up, if you get too many layers of that, and people usually tend to say that they're not doing that, so they don't get cut automatically, but you get some fluff or some gaming, some sandbagging in the budget. All those terms are kind of interchangeable and used the same way, so that's just a disadvantage of doing that, build up in that participative budgeting. Here's an example of how the budget data would flow. So you have different departments that develop budgets that roll into a factory. Then at the factory level, they're going to look at that and make some changes potentially and roll up the different departments. Goes into kind of more of a corporate, and then up to the head of the company, and then eventually the board of directors if it's got a board of directors managing the company as well. So it kind of just keeps rolling up to the next level, similar to the organizational structure. So budgeting and long-range planning. So biggest differences: time period involved. We talked about the budget being commonly an annual, broken into months and quarters. If you look at long-range planning, sometimes it's referred to as LRP for long-range planning. You're looking at 3 to 5 years. I've been in different companies that, some do 3 years, some do 5. And again, as you get further out, you're going to have less reliable data. You're making guesses at what you think the sales growth is going to be, and we used to call it a go-get. So we increased our sales in year 3 because we're going to go get some new customers. Not sure what that's going to be. Not sure who that is. Not sure how realistic that is, but it gives us kind of a framework to say, yeah, we need to increase our sales in order to keep our profit growing. The emphasis. So you're going to look at different things where a budget is being built from the ground up and being built at almost an account level and rolling up. The emphasis on a long-range plan is more, okay, yeah, we think SG&A is going to be X% of sales, so we're not going to worry about where that's coming from or what it is exactly, but if we keep that same percentage, that makes sense, or decrease that percentage over time, that type of thing. And then the amount of detail presented. So you're going to have more kind of goals and organizational type of things in the long-range plan instead of the number of financial statements and the level of financial statements as well. So another review question: the essentials of effective budgeting do not include, so A, top-down budgeting, B, management acceptance, C, research and analysis, or D, a sound organizational structure. Remember what we looked at? The top-down budgeting, because the effective budgeting, especially a participative budget, is really bottom to top instead of top down. The master budget. This is a set of interrelated budgets that constitutes a plan of action for a specified time period. It contains two classes of budgets. First is the operating budgets. That results in the preparation of a budgeted income statement. So you're looking at different departments, different areas in the income statement, and we'll see kind of more how some of those are developed later in this chapter. And then you get your financial budgets, which starts with the budgeted income statement from the operating budgets, but then also we're looking at capital expenditures budgets, cash budgets, and budgeted balance sheets. And here again are some components of the master budget, starting with the sales budget. You can develop a production budget. From there, you get direct materials, direct labor, manufacturing overhead budget. Then you'll add in your selling and administrative expense budget, get your budgeted income statement. That will then feed into a cash budget. Look at your capital expenditures that feed into the cash budget as well, and then you get your budgeted balance sheet, and then your financial budget is that bottom part there. So let's look at some terminology that we've talked about. So we've got this list of items. We're going to fill in the blank for some of these statements. So a blank shows potential sales for the industry and a company's expected share of such sales. Okay, and that's the sales forecast or the sales budget. Blank are used as the basis for the preparation of the budgeted income statement. Again, if we look back at that previous slide and what went into our income statement, that's our operating budgets. The blank is a set of interrelated budgets that constitutes a plan of action for a specified time period. And that's the master budget. Blank identifies long-term goals, selects strategies to achieve these goals, develops policies and plans to implement the strategies. And that's long-range planning. Again, we're looking longer term, and it's sometimes a higher level than what the budget is, not as detailed, looking at overall goals. Lower level managers are more likely to perceive results as fair and achievable under a blank approach. That's that participative budgeting approach. And then 6, blank focus primarily on the cash resources needed to fund expected operations and planned capital expenditures. That's the financial budgets. That's our overview. Now we'll get into how do we actually prepare some of these budgets. So we'll look at sales, production, and direct materials first. Sales budget, typically the first budget prepared. It's derived from a sales forecast, management's best estimate for sales revenue. Every other budget depends on a sales budget. So depending on what you sell is going to determine what you need to make, what you need to buy, that type of thing, how much you need to work. It's prepared by multiplying expected unit sales volume for each product times anticipated unit selling price. So here's the illustration. We're going to go through the Hayes Company. We're going to see how this builds together throughout the chapter. So we'll refer back to some of these things as we see how other budgets are developed and how the master budget and income statement come together. So we expect sales volume to be 3,000 units in the first quarter with 500 unit increases in each succeeding quarter. Sales price is $68 per unit. Put together the sales budget, simply take those 3,000 units times $60 to get our total sales dollars for the quarter. We're doing it by quarter here. So 3,000 is the unit sales in quarter one increases by 500 units to 3,500 in quarter two, still times at $60. Quarter three goes up another 500, so it's 4,000. 4,500 for quarter four, 15,000 units for the year. So that's the putting together the sales budget. Very simply, there's a lot that goes on to get those sales units. That's what we're talking about earlier. If you look at what the industry's doing, what your market share is. So we're growing expected sales quarter over quarter here. So that's got to be determined. Is it the industry growing? Is it cyclical? Are you taking more market share and trying to win that? So there's a lot of things that go into how do you get those sales units. A production budget, that's next. It shows units that must be produced to meet anticipated sales. Okay, that makes sense. You're growing your sales like we just saw. You're going to have to grow your production to meet those sales. So it's derived from the sales budget plus the desired change in ending finished goods inventory. So you need to think about how do I want to end the period quarterly, as we're talking about here, to be able to be in a kind of comfortable position where I can meet the sales of the next period and also have some safety stock. So it's essential to have a realistic estimate of ending inventory, and the required production units we get from what our expected sales units are, what our desired ending finished goods units are, minus what our beginning finished goods units are. Okay? And that gives us our required production units. So back to the Hayes Company, they believe they can meet future sales needs with an ending inventory of 20% of next quarter's budgeted sales volumes. Okay, and this is typical that they take looking at the next period, whether it's next month, the next quarter, whatever it is, and say, all right, if I need a percentage of that to be done already, and then I can manufacture the rest of it to meet the sales of that quarter in this case. So they pick, they looked at historically and they say, all right, if we get 20% of next quarter's budgeted sales volumes and our ending inventory, we should be in good shape. Again, our sales units are increasing each quarter, so our ending units required is going to increase as well. So we have our expected sales in the first line. We add in our desired finished goods inventory, which is a percentage of the next quarter sales. So that gives us our required units. And then we subtract our beginning, and our ending from one quarter is going to be the beginning of the next quarter. And that gives us what we need to produce in each quarter or each time period. Okay, we're growing our sales. We're also going to be growing our inventory then. So you can see our required production units is more than our sales for the year. Direct materials budget then, we're going to start with our units produced times the direct materials units per unit produced. So how much material goes into each finished goods unit, that gives us our direct materials units required. Then again, if we take that, what's required, similar to what we did with sales and beginning and ending inventory, we do that with direct materials. So what do we need for production plus what we want in ending inventory minus our beginning direct materials units gives us what our direct materials to be purchased are. And then once we have what's purchased, we put the cost per direct materials unit against those units to get our cost of direct material purchases. So each unit produced requires 2 pounds of raw materials at a cost of $4 per pound. Hayes maintains an ending inventory of raw materials equal to 10% of the next quarter's production requirements. The desired ending direct materials amount is 1,020 pounds for the fourth quarter of 2027. So that's looking ahead to the first quarter of 2028 in our example. Then we're going to prepare a direct materials budget using this information. So here's how we put together the direct materials budget. Start with the units to be produced, the number of direct material units per unit produced, so 2 in this case. We have our desired, so that gives us our direct materials required for production. That gives us our desired ending, and then we put our desired ending direct materials, that gives us our direct materials required. Subtract our beginning inventory, gives us what we need to be purchased in pounds, the cost per pound, and the cost of direct material purchases. Now we'll do it again with some new information. So Soriano Company is preparing its master budget for 2027. Relevant data pertaining to its sales, production, and direct materials budgets are as follows. Sales for the year are expected to total 1,200,000 units. Quarterly sales as a percentage of total sales are 20%, 25%, 30%, and 25% respectively. The unit selling price is expected to be $50 for the first 3 quarters and $55 beginning in the fourth quarter. Sales in the first quarter of 2028 are expected to be 10% higher than the budgeted sales for the first quarter. So production, management desires to maintain the ending finished goods inventory at 25% of the next quarter's budgeted sales volume. In direct materials, each unit requires 3 pounds of raw materials at a cost of $5 per pound. Management desires to maintain raw materials inventories at 5% of the next quarter's production requirements. Assume the production requirements for the first quarter of 2028 are 810,000 pounds. So based on this information, we can prepare sales, production, and direct materials budgets by quarters for 2027. So we'll start with the sales budget. So again, we have the annual sales in units that was given to us, 1,200,000. We divide that into quarter based on the percentages. It's 20, 25, 30, 25. Selling price, $50 for the first 3 quarters per unit, and then in the fourth quarter it was $55. Put that together, and our total sales for the year are $61,500,000. Now the production budget, we take our sales units, look at what our beginning or desired ending inventory is, added to that sales minus our beginning inventories, and we get our required production units. So we get our expected sales units from the sales budget, our desired ending finished goods, 25% of next quarter's unit sales. They gave us what our first quarter or first quarter 2028 was to get our ending for fourth quarter. Remember, that was 10% of this year's first quarter, so we have to do a little bit more math there. And then we get what our beginning inventory is, and we get our required production units. So 1,206,000 units produced to get our 1,200,000 units of sales, and then our desired ending inventories. Next to the direct materials. So once we have our production, how much we're going to produce each quarter, we can see how much direct materials is in each unit, and then go from there to build our direct materials budget. So we start with our units to be produced. It's 3 pounds of direct materials per unit produced. So we multiply it by 3 to get the pounds needed for production. Again, we add in what our desired median direct materials inventory is going to be. This is in pounds. So we get what our direct materials required, subtract our beginning each quarter, our beginning inventory. That figures out what we need to purchase. And then $5 per pound gives us $18,101,205 is our total cost of direct materials purchases. So that's our sales, production, and direct materials budgets. Now we'll look at our direct labor, manufacturing overhead, selling and administrative expenses, and then finally pull it all together into a budgeted income statement. So for direct labor, it shows both quantity of hours and cost of direct labor necessary to meet production requirements. Critical in maintaining the labor force that can meet expected production. The equation is units to be produced times our direct labor hours per unit times direct labor cost per hour gives us our total direct labor cost. So direct labor hours are determined from the production budget. Again, we're building on a previous budget to look at the number of units to be produced. At Hayes, 2 hours of direct labor are required to produce each unit of finished goods. We're going to pay $10 per hour. So units produced times 2 is the total hours to meet that production at $10 per hour, then get our direct labor cost. Manufacturing overhead shows expected manufacturing overhead costs for the budget period, distinguishes between fixed and variable overhead. So remembering some of our past chapters, how we dealt with overhead, we're going to apply that in a budget perspective. So Hayes Company expects variable costs to fluctuate with production volume on the basis of the following rates per direct labor hour. Indirect materials are $1. Indirect labor is $1.40. Utilities 40 cents. And maintenance 20 cents. So for the 6,200 direct labor hours that we calculated in the direct labor budget, that's what we needed to produce our 3,100 units. We multiplied that by those 6,200 hours by our hourly rates for indirect materials, indirect labor, and then our maintenance is fixed. So we can pull that together to get our overhead budget. So our variable are the rates that we just talked about. Then our fixed costs, which are given to us. And you see that maintenance is mixed. It's got some variable at 20 cents per hour. And then we have some fixed costs as well. Then now we can get a total manufacturing overhead rate per direct labor hour, taking our total manufacturing overhead divided by our total direct labor hours. So $8 per hour is our manufacturing overhead rate. Selling and administrative expense budget. It's the projection of anticipated operating expenses. Again, it distinguishes between fixed and variable. So variable expense rates per unit of sales are sales commissions of $3 and freight out of $1. Variable expenses per quarter are based on the unit sales from the sales budget. So again, going back to that first budget we did, we're going to use that data again. and expects sales in the first quarter to be 3,000 units. Fixed expenses are based on assumed data. So that's what they're going to show that on the next slide. So we're going to prepare this selling and administrative expense budget. So we have our variable expenses, commissions and freight out. And then we have our fixed expenses, which again, fixed, same each quarter. And we get our total selling and administrative expenses. So now that we've completed all of our operating budgets, we can create a budgeted income statement. In the product for operating budgets indicates expected profitability of operations, provides a basis for evaluating company performance, prepared from the operating budgets. Remember, we did the sales, production, direct materials, direct labor, manufacturing overhead, and then our selling and administrative expenses. So we're going to use all that data to do our income statement. Now, we did our direct materials, direct labor, manufacturing overhead based on production, which doesn't give us our cost of goods sold. It gives us our cost of production. So to find the cost of goods sold, we must first determine the total unit cost of producing one right ride bicycle seat. So we take our direct materials, our direct labor, manufacturing overhead per finished goods, and we come up with $44 per unit is our cost of goods sold. So we multiply that by the units to be sold, 15,000 units at $44, 660,000 is our cost of goods sold. And then we can pull that together to get our income statement. Everything comes from the operating budget except the interest expense, which is expected to be $100, and income tax is estimated to be $12,000. So income tax, you can, the tax department will typically give you a rate of what you use based on your income before taxes. Interest expense, a lot of times that comes after we do the cash budget to see what we need to borrow, if anything. So sometimes iterative, where you'll use your operating budgets to get income from operations, then continue with some other budgets, and then come back to complete the income statement. So review question, each of the following budgets is used in preparing the budgeted income statement except we have sales budget, selling and administrative budget, capital expenditure budget, and direct labor budget. So which of these is not used in preparing the budgeted income statement? The answer is the capital expenditure budget. So we'll do it, continue with the Sariano Company preparing its budgeted income statement for 2027. So we looked at previous do it, and we got our sales, production, direct materials budgets. We're going to use some of that to continue. We budgeted a half an hour of direct labor per unit, labor costs at $15 per hour, manufacturing overhead $25 per direct labor hour. Selling and administrative expenses for 2027 are $12 million. We need to calculate the budgeted total unit cost to prepare the budgeted multi-step income statement. So going back to those others, we can find the information for direct materials, 3 pounds per unit at $5 per unit. Our direct labor at a half hour, $15 per hour, and manufacturing overhead half an hour at $25 per hour, $12.50. So our total unit cost is $35. With that, we can take our sales from our sales budget we did before, the 61,500,000. We have 1,200,000 units at $35 per unit. Our cost of goods sold is $42 million. our gross profit, 19,500, and our $12 million of selling and administrative expenses gives us our net income, $7,500,000. Next, we're going to prepare a cash budget and budgeted balance sheet. Cash budget shows anticipated cash flows. It's an important output in preparing financial budgets. And we have three sections similar to three sections of our cash flow statement, but they're slightly different. We're going to just look at cash receipts. So we're going to look at receipts instead of cash flows from operations, and then cash disbursements. Again, instead of just the operations. So it's a little bit different, but three sections again, and then we'll look at financing. Shows our beginning and ending cash balances. Well, once we have this, we can then prepare a proper statement of cash flows if necessary. So again, take our beginning cash balance, we'll add in our cash receipts. It says itemize there, so we can itemize exactly where the receipts are coming from and be able to change different assumptions if needed. That gives us our total available cash. Then we'll subtract our cash disbursements, again itemizing if needed. Then that will give us our excess or deficiency available cash over cash disbursements. A lot of times companies have a target of what cash balance they want to maintain, which then will lead them to how much financing, borrow cash to be able to get their desired ending cash balance. The cash receipts section is the expected receipts from the company's principal sources of revenue. So that would be our accounts receivable, basically. So as we sell things, we're either going to sell for cash or on account, and we collect our accounts receivable. That's where we're getting our majority of our cash receipts. Then we're also going to look at any interest or dividends that we expect to receive, proceeds from planned sales of investments, planned sales of planned assets, and companies' capital stock, so free to issue stock. Then if we look at the cash disbursement section, it's the expected cash payments. Things that we're going to pay cash for are direct materials, direct labor, manufacturing overhead, selling and administrative expenses. This includes payments for income taxes, dividends, investments, foreign assets, everything that we're going to spend cash on. And then our financing is our expected borrowings and repayments of our accounts. So some concepts of the cash budget must prepare in sequence. We start with the beginning cash, what we receive to find out what's available, and then what we're going to pay cash for. The ending cash balance of one period is beginning cash balance for the next. Data obtained from other budgets and from management is what we're going to use to prepare our receipts and disbursements. Often prepared for the year on a monthly basis. So we'll see how each month we're going to have excess or a deficiency of cash and need to borrow. Contributes to more effective cash management. Shows the managers the need for additional financing before actual needs arise, so we can plan for that. It indicates when excess cash will be available. So we're going to start with our schedule of expected collections. This is based on the following assumptions. Okay, so for the Hayes Company, we're going to say 60% are collected in the quarter sold. So our sales for the quarter, 60% of that sales are going to be collected in cash that quarter. The remaining 40% are collected in the following quarter. And then we have the additional information that accounts receivable is $60,000 on December 31st, 2026. So the end of the previous year are expected to be collected in full in the first quarter of 2027. Okay, that's most likely our 40% of the sales from that quarter. So here's how that would look. So we list the quarters both going down and across. You could do the same thing for months if we were looking at this monthly. We first list our sales by quarter going down. That's from our sales budget. And then our collections for the quarters going to the right. So the first quarter is our 60,000 from our accounts receivable. And then 60% of our first quarter sales, 108,000. So 168,000 in quarter one. Quarter two, we're going to get 40% of our first quarter sales, so the remaining amount, and then 60% of our second quarter sales. And that continues for each of the other quarters. And we can look at our expected payments for direct materials. And then the assumptions we're using there are direct materials, 50% paid in the quarter purchased, 50% paid in the following quarter, based on our payment terms and buying on account. And then it tells us that at the end of 2026, we have 10,600 of accounts payable. We expect to pay that in the first quarter. So the schedule looks very similar, except instead of sales, we're going to have our purchases. So we expect to purchase. So again, first quarter, we have our accounts payable that we're paying off from the previous year. And then we have 50% of our purchases for the first quarter paid in the first quarter. Second quarter, we pay the remaining 50%, and then 50% of our second quarter purchases. And then we continue that for the third and fourth quarter. And then some additional assumptions. On January 1st, 2027, the cash balance is expected to be 38,000, days which is to maintain a balance of at least 15,000. Short-term investment securities are expected to be sold for $2,000 cash in the first quarter. So that's going to be additional cash receipts. Direct labor. So from our direct labor budget, 100% paid in the quarter incurred. So we pay everything in that same quarter. Manufacturing overhead and selling and administrative expenses, all items except depreciation are paid in the quarter incurred. So again, nothing carries over into accounts payable for those items. Number 5, management plans to purchase a truck in the second quarter for $10,000 cash. So an additional cash outflow. Hayes makes equal quarterly payments of an estimated $12,000 annual income taxes. So $3,000 per quarter. Loans are repaid in earliest quarter when there is sufficient cash. So again, we want to maintain that $15,000 minimum required balance of cash. So if we fall short of that, we're going to borrow money. If we exceed that, we then can pay back our loan as soon as we have that excess. So we're using all those assumptions in our cash disbursements for direct materials, cash receipts for sales. We can put together our cash budget, which looks like this. So we have the collections from customers that we created, so we can layer that in. We have our sale of investment securities in the first quarter that we had in our assumptions. So we have our total receipts and then our total available cash. Direct materials payments, we get that from our direct materials schedule that we just did. We look back at our direct labor from earlier, pay in the quarter we incur it, so we can layer that in. Same with the manufacturing overhead. Okay, that is an adjustment we make though to take out depreciation. Again, depreciation is not a cash item. So remember when we did our cash flow statements, we would add back depreciation. We're doing the same thing here. We're adding that back to our manufacturing overhead. So the cash on manufacturing overhead is going to be less than our manufacturing overhead budget because of depreciation. Same thing on the selling and administrative expenses. If there's a depreciation in there, we have to add that back. We have our purchase of truck in the second quarter, so we layer that in. We have our income tax, $12,000 spread evenly over each quarter. And then we have excess or deficiency with available cash over cash disbursements. In this case, each quarter we're positive, so we have excess cash. But if you notice in the second quarter, it's only $12,000, so we're going to borrow money to get our $15,000 cash balance that we want. So we show that in borrowings. And then we have the excess cash in the next quarter, quarter three, so we can pay back that borrowing plus interest. So that's why that's at $3,100. We're including the interest in there. And then we have our ending cash balance for each quarter, which again becomes the beginning cash for the next quarter. So we can't go across each item. We have to do a column, pull that beginning, and then complete the column going down for the next quarter. Budgeted balance sheet. It's the projection of financial position at the end of the budget period. Developed from budgeted balance sheet for preceding year or forecasted balance sheet from the preceding year and budgets for the current year. So if we looked at our budgeted balance sheet for December 31st, 2026, we can see what our buildings and equipment are, our accumulated depreciation, common stock, and retained earnings. Okay, the information we know, we are buying a truck, so that's going to change our buildings and equipment. We can figure out what our depreciation is from our various budgets. We didn't anticipate in our cash budget any sale of stock, so that's probably not going to change. And then our retained earnings, again, is our net income minus our dividends. So for the balance sheet, our ending cash balance is shown in the cash budget. So that ending is going to be our cash for the period. The accounts receivable, 40% of fourth quarter sales, shown in the schedule of expected collection from customers. That's going to be our accounts receivable balance. We have our desired ending finished goods inventory of 1,000 units, showing the production unit times the unit cost of $44. We also will have raw materials inventory from our direct materials budget. Our buildings and equipment, we had the 182 ending plus the purchase of the truck, so that's going to increase it for the end of the next period or next year. Accumulated depreciation plus our depreciation expense from our overhead budget and our selling and administrative budget. It's going to increase our accumulated depreciation. Accounts payable is going to be 50% of fourth quarter purchases. Common stock is going to be unchanged, and retained earnings, the balance plus net income, is going to increase that. We don't have any dividends, so we're not decreasing it for dividends. If there was dividends, that would affect our retained earnings as well. So with all that information, we can do our budgeted balance sheet. When I've done this for companies, we've actually end up doing a monthly balance sheet. So it's taking all that information that we just kind of looked at and layering it month by month. It's a little bit more complicated than what we just did. So review question. Expected direct materials purchases in Reed Company are $70,000 in the first quarter, $90,000 in the second quarter. 40% of the purchases are paid in cash as incurred. The balance is paid the following quarter. The budgeted cash payments for purchases in the second quarter are $96,000, $90,000, $78,000, or $72,000. So we're looking at the second quarter. 40% of the purchases are paid in cash as incurred, so we're going to take 40% of the $90,000. But the remaining is paid the following quarter, so 60% of the first quarter. So we have 70,000 times 60%, 90,000 times 40%, gives us 42,000 plus 36,000, so 78,000 is our budgeted cash payments for the second quarter. So company management wants to maintain a minimum monthly cash balance of $15,000. Beginning of March, cash balance is $16,500. Expected cash receipts for March are $210,000. Cash disbursements are expected to be $220,000. How much cash, if any, must be borrowed to maintain the desired minimum monthly balance? So we're going to take our beginning cash balance, $16,500, add our expected cash receipts, subtract our expected cash disbursements. If we do that, we see that we have excess available cash over cash disbursements of only $6,500. If we want the $15,000 cash at the end of the month, we need to borrow $8,500 to get there. So again, beginning cash plus our receipts less our disbursements is what we have as our expected cash balance, which we call the excess or deficiency available cash over cash disbursements. We then compare that to what our what we want to maintain as a minimum monthly cash balance or quarterly, whatever period we're doing this for, and then we can borrow if we need or if we're short of that. If we have access to that and we borrowed previously, we'll typically pay down some of that borrowings as long as we still have that same minimum. And our last objective is to apply the budgeting principles to non-manufacturing companies. So we'll start with merchandisers. Sales budget, starting point, and key factor. Okay, so similar to the manufacturing, we're going to use the sales budget. We're going to use a purchases budget instead of a production budget. Okay, so we don't have to worry about production, but same concepts of our direct materials we're going to use for our merchandise inventory. We don't use the manufacturing budgets, so direct materials, direct labor, manufacturing overhead, but we use the merchandise purchases budget. So we have our budgeted cost of goods sold plus our desired merchandise inventory minus our beginning merchandise inventory gives us our required merchandise purchases. So we'll look at an example here. Lime estimates budgeted sales will be $300,000 in July, $320,000 in August. Cost of goods sold is expected to be 70% of sales. Lima's desired ending inventory is 30% of the following month's cost of goods sold. Required merchandise purchases for July are computed as follows. So we take our budgeted cost of goods sold for the month, so the $300,000 in sales times 70%. Our desired ending merchandise inventory is 30% of the following month's cost of goods sold. So we estimated $320,000 of sales. 70% of that is $224,000. That's our cost of goods sold for August. Take 30% of that is our desired ending inventory at the end of July. So $277,200 is our total. We subtract our beginning inventory, which is 30% of this month's cost of goods sold. So 30% of the $210,000, and we get our required merchandise purchase for July, $214,200. So that's how you would look at it for a merchandiser. Service companies, critical factor in budgeting is coordinating professional staff needs with anticipated services. Problems arise if you're overstaffed. We have higher labor costs, lower profits due to additional salaries, staff turnover due to lack of challenging work. You can have problems if you're understaffed. You have lost revenues because existing and future clients' needs for services cannot be met. Loss of professional staff due to excessive workloads. So they got to balance that workload for the professionals with what you think your services are going to be. So Stefan Lawn and Plowing Services estimate that it will service 300 small lawns, 200 medium lawns, 100 large lawns during the month of July. It estimates its direct labor needs as 1 hour per small lawn, 1 3/4 hours for a medium lawn, and 2 3/4 hours for a large lawn. Its average cost for direct labor is $15 per hour. You can prepare a direct labor budget as below. So we have small, medium, and large lawns, the number of lawns for each of those, the hours per lawn that we just learned about. So that gives us our total direct labor hours required, and the cost per direct labor hour gives us our direct labor cost. So that's how you would build the direct labor budget for a service organization. And then non-for-profit, just as important as for profit-oriented company. The broad budget process differs from profit-oriented company. The budget on basis of cash flows, so expenditures and receipts, not revenue and expenses. Starting point is usually expenditures, not receipts. Management's task is to find receipts needed to support planned expenditures. Budget must be followed. Overspending is often illegal. So you're going to look at what you think your expenditures are going to be, your salaries, any services you're providing, that type of thing. Then you're going to have to match your receipts to those expenditures. And so you're going to look at different fundraising and that type of thing to be able to meet those expenditures. And a lot of times the not-for-profit follows government accounting. So the government, there's typically a separate class on how government accounting is handled, because it's a little bit different than a for-profit public or private company, even under government regulations, and there's government generally expected accounting standards that we have for companies that we're learning. There's separate ones for government, and a lot of times not-for-profits follow that as well. A review question. The budget for a merchandiser differs from a budget for manufacturing because merchandise purchase budget replaces the production budget. Manufacturing budgets are not applicable. None of the above, or both A and B above. And the answer is D, both A and B above. So let's look again at another example of the merchandise purchase budget. Becker estimates 2027 sales will be $15,000 in quarter one, $20,000 in quarter two, $25,000 in quarter three. Cost of goods sold is 80% of sales. Management desires to have ending finished goods inventory equal to 15% of the next quarter's expected cost of goods sold. Prepare a merchandise purchase budget by quarter for the first 6 months of 2027. So we're looking at the first 2 quarters. We have cost of goods sold, which is 80% of sales. We can calculate that. Ending merchandise inventory is going to be 15% of next quarter's cost of goods sold. and then we subtract our beginning inventory from that to get our required merchandise purchases. So that's it for Chapter 9 in budgeting. A lot of information we covered. Make sure you review this before you do your homework. I've also posted some challenge exercises, and we'll post the solutions to that in a few days later this week. And as always, reach out if you have questions. Thank you.